Gold has recently formed a triple top formation. Technically speaking, I am I have very strong conviction that we're going to see gold breaking out to new highs, and it's going to be what triggers a new cycle. Once we do that, I would say that silver is likely to actually lead the way to the upside, like we saw during other times. And what is interesting about this is that I've never seen a time where you have all these reasons to believe that we're going to enter or we are in the onset of a secular move to the upside for the metal.
With a keen eye on the intricate threads that weave through the world's economies, Tavi Costa, a partner at Crescent Capital, has recently shared his compelling macroeconomic perspective, one that shines a spotlight on the allure of commodities, particularly the radiant promise of gold and silver. Gold and silver prices are modestly lower in midday U.S. trading Thursday on downside corrections following this week's gains. According to Tavi, he is highly confident that gold is poised to break its previous price highs and embark on a new upward trajectory. One of Tavi's reasons for optimism regarding silver is its increasing demand, driven by applications in solar panels and electric cars. The Silver Institute's projection that 70 to 80 million ounces of silver will be required annually until 2030 to support the growth of solar energy. Tavi also points out that the gold-to-silver price ratio is historically high, with the current ratio standing at around 79, meaning that 1 ounce of gold is currently worth 79 ounces of silver. This high ratio suggests that silver may be undervalued compared to gold, making it an opportune time to consider investing in silver. Just before you watch the Tavi Costa's interview and learn more about market trends, consider subscribing to our channel and give this video a big thumbs up.
In a world where the green revolution and the need for electrification metals is certainly I would say even in surging across the global economy, you would likely see that silver would play a bigger and bigger role in terms of the demand side from those developments. And so in that front, I'm very bullish on that. I also think look, throughout history, when you see a gold cycle, and I think we're going to enter one here very soon, the gold and silver ratio is at about 80, in which is a historically high measurement relative to even times like the 70s. And so to me is it's almost like a gift. It's a very attractive levels to be entering this market. And so even better if you can find a high quality business that owns a large deposit of silver, or is a very high quality producer of that as well, which there are not many out there. And so, to me, it's as close of a no-brainer as it gets. And so I'm very focused on silver. Gold is for a lot of reasons. I've never seen a time with so many reasons to be long gold, and this overwhelming skepticism towards the metal. The fact that central banks and other large institutions begin to really focus on enhancing the quality of their balance sheets. And in order to enhance that, they need gold. And so I just find it hard to believe we're not going to see a trend towards a higher percentage of ownership of gold relative to U.S. Treasuries, despite the fact that interest rates can be higher. And so, and this is certainly what we saw in the 70s, what we saw in the early 2000s. And I do think we're going to see it again, where gold really outperformed treasuries on a total return basis, despite the fact that it pays out a yield, obviously. And so, and gold doesn't. And so I will stay firm on that. And I think that when you look at the valuation of companies in this industry, in the gold space, they are already, as I said before, priced for failure. So to me, it sounds really interesting. Silver goes to $50 an ounce and you own a large deposit in the ground today, that company itself, the valuation of that business, it will be drastically higher given the leverage to the silver price itself, and leverage not in a sense of debt, just in a sense of just the upper movement of the actual price behavior. And so, to me, that's really where I'm really excited about is more an exploration. But again, I think the overall industry would do very well. I think there will be, royalty businesses, producers, developers, explorers will all do extremely well in a gold cycle, as we tend to see. And this whole idea that the mining industry is dead and so forth, I think will be proven wrong in the near future here. So I'm happy to be to go against that trend, because I've seen before when this need for a contrarian opinion when it comes to when markets the conventional thought that the miners are just capital bleeders and so forth. That was the case 10-15 years ago. I think today those companies have very different management and very different ways to be in a position to really capitalize on this in this gold cycle. So it's a very exciting part of the market that I think a lot of people are dismissing today.
Tavi Costa underscores a stark division within the precious metals industry, distinguishing the top 10 companies from the bottom 40. While the top 10 thrive, the bottom 40 face challenges. The Northern Miners compilation of year-to-date top 10 drill results for major metals highlights the success of projects in Australia and Canada, with Australia dominating the top 3 and Canada claiming 6 spots, while Serbia emerges as an outlier in second place. Tavi points out that investors are starting to demand more projects and ways to increase production over time, a pivotal response given the backdrop of rising interest rates and structural economic weaknesses. Gold mining stocks are re-emerging as trusted havens amid market uncertainty, yet they remain exposed to market and operational risks tied to volatile commodity prices that significantly influence their profitability. Let's get back to the interview.
When commodity markets tend to happen, you can unleash some parts of it in a very pronounced way. And I think we've had that with energy. Energy in 2021 and 2022 had very strong years. And when you look back or in those periods, what you're going to find if you backtest the companies that have done very well were the companies that were very aggressive with capital spending and creating increasing production and other things. And it wasn't really related to cutting costs and other things that we're seeing in the mining space. And so I think this is going to apply to the mining space in a large way. When we look at the top 50 businesses in the mining, across the miners now in the precious metals industry, what we find is that there's a big difference between the top 10 and the bottom 40. The top 10, and I'm talking about the top 50 companies. The top 10 are usually exactly what you said. It's lack of capex, which is causing as well. Their cash flows are improving because of the price of gold, and then you see free cash flow generation. Actually, throughout history, we haven't really seen that amount of free cash flow generation that we have today. Their balance sheets are looking healthier. So there's a lot of things going on in terms of the top 10 that are somewhat optimistic in regards to them being very much more conservative than other periods in history. Now, the bottom 40 is a complete different scenario. You're seeing this push towards increase of production. You're seeing capexes are already higher than they were back in 2011, although the overall level is very low. When you looked at just the bottom 40, capital spending is certainly occurring already in the smaller companies. And so, and production itself, although a lot of the bottom 40 are not currently producing assets, they do have, some of those folks, those businesses are already doing much better. But you see that the way the market is reacting towards those companies that are being more aggressive is very similar to the energy space. They're not being penalized for not being ultra conservative like the top 10. So that is an interesting take, because I think we're starting to see investors demanding more projects, demanding more, I guess, a way to increase production over time as well. And I think this is important in a lot of aspects. Eventually, those companies, when you looked at overall reserves of the major companies in the mining space, it's not only the fact that they have been depleting their reserves, but also when you look at the quality of those, they've been deteriorating significantly. So the average grade of the reserves of most of those major companies has been, in a deteriorating, a trend for the last 2 to 3 decades. And when you also looked at the big companies like Newmont, Barrick, Kinross, AngloGold, and so forth, they've been in a secular decline of gold production. I guess, Newmont is less of a trend but it's, the production of Newmont today is the same as it was, over a decade ago. And so there hasn't been much of a growth in revenues relative to gold prices. And I'm not even talking about costs. I'm just talking about the top line. The revenue side is not following the gold price itself, which is really interesting. We are entering a gold cycle. We're going to see something that we saw in the 70s and even in the early 2000s, which is the exploration side of the industry will outperform other parts of the market. And that is just because, that's where most of the billionaires made their money. Majority of the billionaires in the industry are the ones that actually found major discoveries in the past, but it carries higher risk.
In the realm of precious metals, silver has often been dubbed the cheap gold. However, Charlie Morris, Chief Investment Officer at Asset Management, sees silver's recent resilience and foresees potential supply deficits, suggesting that its upside might surpass that of gold. Meanwhile, the United States Central Bank boasts a substantial gold reserve, exceeding the combined holdings of Germany, Italy, and France. Tavi Costa, another prominent voice in the field, discusses gold's pivotal role in central bank strategies. Central banks increasingly favor gold to enhance financial stability, potentially surpassing U.S. Treasuries in holdings. Despite recent fluctuations in U.S. Treasury yields and the strength of the U.S. dollar, gold has exhibited remarkable resilience. Even in the face of rising real interest rates, gold remains steadfast. That's it for today. Share your thoughts on how might these evolving trends in commodities, particularly gold and silver, impact the broader financial landscape and the investment decisions of individuals and institutions alike. If you liked the video, don't forget to subscribe to our channel and tap the bell icon so you don't miss out on our upcoming content. Thank you for being a part of our community.